All right, good afternoon to our friends here on the East Coast, and good morning to the rest of the country. We appreciate you joining us. We have an action-packed 45 minutes ahead of us. I have my friend and associate Scott McHenry here to be the subject matter expert. Scott, thanks for joining.
Thanks, Anthony. Appreciate the opportunity to be here.
So we've put this plan together. It's an area that I cut my teeth on in the industry back in 2001, where the Pension Protection Act afforded us some flexibility and opportunity for small business owners. And it's an area that we've gotten away from. Obviously, Scott hasn't. But as we continue to see small business owners thriving, we find more and more need for assistance, tax strategies, right? High net worth business owners looking to create wealth, reward employees. So today we put this together, designed specifically for financial advisors and life insurance agents who are looking to implement and learn about tax efficient retirement planning solutions. And we're going to do it in two ways, right? There's the what I call the new money plan, right? Establishing a plan, adopting a plan, creating wealth in the plan with new money, aka cash balance plans, pension plans, right? Closely held business owners. And then part two is, okay, what happens when you've created so much wealth inside your qualified plan that it becomes this tax time bomb that's valued at twice when it comes to the IRS. So I will say this before I turn over to Scott and start asking him a series of questions and learning a little bit more about how he approaches the market. I have worked with several life insurance companies and their advanced markets programs in designing qualified plan templates. And what I can tell you is that the customization that Scott and team bring to the table is a completely different experience. And that is no fault to our carrier partners. Their software and the ability for them to put out plan designs are limited. What we see historically and what you may have seen is lifetime pay life insurance policies, option A versus option B in accumulation type strategies, the unknown valuation at exit. There are so many unknowns and ongoing commitments in some of the plan designs that you look at in today's world that sometimes the plan design just doesn't even make sense. What I'm learning and what I've learned in working with Scott is that there is a methodology in how to create a plan design, how to manage an ongoing plan, and how to exit the plan so that that life insurance policy becomes an asset and not a liability going forward, right? There are so many instances where I see a termination of a pay to 100 whole life policy in year 11 where you barely broke even and you could have accomplished the same exact thing with some outside term insurance and really didn't get the most value for your contribution. The McHenry plans will counter that argument, and I think it's going to be eye-opening to learn how adding life insurance to the plan can be an asset and not just an additional expense. Scott, did I do you any justice?
Oh, I think so, Anthony.
Right.
I think you hit everything. So I appreciate it.
All right,
So
so Scott, tell us a little bit about who you are, what you do, and how you help agents create your qualified plan opportunities.
yeah, so I'm an enrolled actuary by training, right? So retirement plan actuary. Our company is a retirement plan actuarial and third party administration firm. All that we do are qualified plans, set up, design, administration. But I would almost go beyond that. I say all that we do are qualified plan tax strategies, really focused on hey, qualified plans are two different things. 401k plans are a great way for employees to save for retirement. That's wonderful. Our focus is how can we help closely held, high income, high net worth business owners get a better outcome out of qualified plans. So we do that by partnering with financial advisors across the country, right, to show them strategies for their clients to save on taxes today, right, with large pension plan contributions, and then have the conversation show the option of how life insurance can improve the qualified plan outcome for the business owner. I have a team of 40 enrolled actuaries, advanced market attorney. We try to be different than other third-party administration firms. We have an executive concierge team that's really their entire focus is on making it very efficient to work with us from the client plan sponsor, from the advisor perspective.
Well said. Okay, ready to jump in, Scott?
Yeah, happy to.
All right. Um, why would a financial advisor or a life insurance professional look to add qualified plans to their vertical of business offering?
Yeah, sure. And I appreciate everyone to be here today, and there's a reason, right, for that, right? If they manage investment assets, I would call it a great way to grow AUM. Not every advisor really knows what they're doing in the qualified plan space. So if you do, it's a great way to grow your revenue, and it's usually more receptive, right? We're going to open the door with saving clients taxes today and in the future, and that's a great way to gather assets and grow your client base and have a great client relationship. It can lead to good life insurance sales inside the plan, right? So when we see life insurance on a cash balance defined benefit plan business owner, average target we're seeing is somewhere around 75, 80,000, right? There's times we add life insurance to existing plans and it's higher. The season money strategy you talked about, can be, significantly higher. So good life insurance sales inside the plan, I would argue they're easier, right? Because you're talking about tax savings, can lead to annuity opportunities, right? Either as a funding vehicle inside the plan. There's a great story that can be told about annuities being a good fit there. And in some instances, kind of to purchase a SPIA on the back end, right? To help with certain types of plans to pay out benefits. So those are all great financial reasons for an advisor to think about qualified plans. I think there's a huge intangible, which is what it does to your client relationship. So Anthony, I can't tell you how many times we've set up a cash balance plan. Somebody loved the tax deduction, right? 4 years in, they go to their advisor, hey, we're selling our business for, X, right? And I loved what you did for me, with the cash balance plan, and I'm going to need some help with managing that larger AUM dollar amount, or help with capital gains or other tax planning. So I think it can do wonders to that client relationship.
Yeah, creates a much stickier relationship, right? If you're purely an insurance professional, it also creates opportunities to get synergistic with a wealth manager who can manage that part of the plan, right?
Yeah.
Start to reciprocate relationships. The
Yeah.
other thing that is extremely, extremely important to us, and where I see value in this, is that we constantly talk about volatility buffer and having a buffer asset and how to plan for years following the down market. The way that we're building these types of strategies kind of package everything up together and then split them apart at or near retirement so that you can have your equity bucket and your buffer asset. So it allows clients to live better, right, and spend more because you have that buffer asset. So you're constantly adding value and creating the stickiness because you're implementing the overall income plan through a tax deductible vehicle up front. So Scott, it was really well said. So throughout your material, you talk about the modern qualified plan, right? Modern being the key word. talk to us about what's modern about your structure and idea of a plan design.
Yeah, and I think it's kind of just battling this misconception, qualified plans, pre-tax, save money today, right? That's usually what gets people interested, business owners interested in at least cash balance plans is I'm making a good income today, I want to pay less in taxes. Great. Nothing against that. But I think qualified plans can do so much more, right? So we use the term modern to kind of highlight, hey, today we can balance that out. We can fund some Roth accounts, right? Which a lot of people really love. That's great. So that in retirement, someone has, the ability to draw down an IRA, great, but there's an income tax consequence. Isn't it nice to have something that can provide some tax-free benefits? Um, and for a lot of our clients, right, the overlap of those that can fund a couple 100,000 to a pension plan, at the end of the day, they're going to be pretty high net worth. They may not need the large IRA for retirement income, but we may have an estate tax problem. So I like the ability to kind of be proactive there, very efficiently fund some life insurance, move it out of the plan at the right point in time, and we can be strategic, right? We know that the life insurance can be used for tax-free income if it's owned personally, right? We know it can be put in a grantor trust and be outside of both income and estate tax. So I think about it as modern, as just kind of not looking at today, but looking at someone's lifespan, right? How can we fund some assets that can be income tax-free, if not also estate tax-free more efficiently?
Well said. Well said. I think the misconception was maybe years ago was that you're building assets inside this qualified wrapper and you're going to have to pay a whole bunch of taxes when you get older. You're just creating the problem for yourself. But in actuality, if you're creating tax-free buckets that will be extracted from this qualified plan wrapper in the future, you're actually diversifying your tax bracket in retirement, and you're playing that tax location story that we always talk about.
Yeah, it's just it's kind of nice in that, I think that's great for everybody, but if your client is a closely held business owner, we can tackle a lot of it really in one place, right?
That's
To
right.
make that
That's right.
conversation a little bit easier.
All right, so you're leading me right into my next question. Who Let's start with plan number one, a cash balance. Who does this cater to? Who's the ideal candidate? Who should the folks in the audience looking to be engaged with in talking and introducing a cash balance plan idea to?
Yeah, I think you start first with the ownership group, right? Closely held group. You know, Single business owner, two owners, maybe up to like seven partners, right? A group that you can get together and explain it, right? It can be flexible. We can have some in, some out, but I kind of need everybody to understand it. That gets, publicly held companies, that's too challenging, right? With people coming and going, with large, super large medical law firms, it becomes a little bit more challenging to really get the stakeholders to in a small enough group to understand it. So that's where I start with is closely held ownership group that can see the value and make decision and move. High income and want to pay less in current income tax. So your clients that are complaining about taxes, hate taxes, well, this is a great story, a great conversation to talk to them about. Ideally, someone with the cash flow to fund 100,000 or more to a qualified plan program. I say that because, someone can contribute 70, sometimes upwards of 80,000 to a 401k plan or SEP, right? So I want people who have the cash flow, the desire to fund more than that. That's really the starting place with a cash balance plan. I used to talk about employee size. I kind of phrase it this way now. If you give me 15 or fewer full-time employees per business owner, that you're looking to maximize, I know we can turn around something and give you 90 to 95% plus going back to your targeted kind of ownership group. But there are some exceptions. We can take this concept and take it up market into larger firms. And I have a slide where I can kind of show you that. So the employee population does matter. Smaller is easier, but I would say if you tick all these other boxes, closely held group, high income, want to pay less than current income tax, and the cash flow and desire to fund a lot towards retirement, then it's worth exploring looking at a cash balance plan. That said, if I look at our clients, so we have 2,300 plus active clients. About 30% of them fit the professional service firm category. All right, medical, dental, law firms, CPA firms, financial advisory firms. About another 30% are owner-only businesses. So think of somebody that has some 1099 income, no other employees. So a lot of commercial or residential real estate agents, a lot of people that may have a side income, all right? So maybe they're a W-2 employee of a hospital system as a physician, but they separately have on-call speaking, writing expert witness testimony, right? Or they're a professional athlete on a team, right? But they separately have off the field endorsement income. So a lot of times we'll set up a pension plan based on somebody's side income. And then the other 40%, closely held family home business, you name the industry, it can be a good fit if they meet the other criteria. So manufacturing, construction, consulting firms of all different types, agriculture businesses sometimes can be a great fit for pension plans. Consistent high income, hey, yeah, that's perfect. But, there are also some times where we can use pension plans to deal with spikes in income. So these plans can be very flexible if you have, personal injury attorneys that have big cases, right? Big spike in income. We can set up a plan, target high contributions in the years they need it, dial down funding in other years.
Well said. So we've established why we should add this vertical to our practice, where the opportunities are, who's a good candidate. Scott, can you get into like some of the rules around creating these large deductions and how a traditional pension would compare to a 401k or profit sharing?
Yeah, I mean, that's if I think about why a cash balance plan, right? You set one up today so that your key people can have larger retirement contributions than they could another type of plan. Um, in a 401k plan, right, or a SEP, there is a limit that's defined, cost of living adjusted, right? It's a set limit. For a 30-year-old, I can't have more contributions to a 401k plan than 70,000, right? In a cash balance plan or traditional defined benefit plan, instead, there's a limit on what can come out of the plan, right? And it's phased in over a number of years. And then it's kind of an actuarial calculation of how do we get there, right? At any age, someone can fund more to a cash balance plan than any other type of retirement plan. That limit, think of it, it's different based on ages, but in the early 60s, if someone's been in a pension plan for 10 years, high income, they could roll out 3.5 million to an IRA. So we work backwards from there. I know somebody's in their 50s or a high income owner, I can easily allow them to fund over 300,000 a year to get to that limit in as early as 10 years. One thing to keep in mind is these things are not mutually exclusive, right? I have a lot of clients that can max out both a 401k plan and a cash balance plan in any particular year. The kind of thing that I realize though is there are lots of business owners that have a 401k plan. It's kind of on autopilot. They think they're maxing it out and they have no idea, right? I can add on a cash balance plan and increase when I'm funding, 4 or 5, sometimes 10 times more than I'm currently doing.
Scott, with a lot of the discussion around these types of plans involve taxes or tax planning, and then secondarily income planning and then employee retention. Give us some estimated income tax savings on some of these plan contributions.
Yeah. So I mean, it depends on state income tax a lot of
Sure.
times, right? But it's not uncommon. We'll set up a plan for a business owner in their 50s and they fund 300,000 a year. And what's nice is we're still in a position where they could set up a plan for 2024. They can adopt it up until the due date of the business tax return. So we could do a side by side, right? You don't set up a plan and you pay X in taxes, or you set up a plan, you fund 300,000, and right off the bat, we saved you maybe 120,000 plus in federal and state income tax savings. These are not maximum amounts. It may be possible that I double these in any particular year, right? So there are times where we'll set up, somebody has a windfall year and maybe they fund, almost 800,000 in any particular year. So that's the door opener, right? Is, hey, let's do this plan so you can save today, right? That you're mad about the amount of federal and state income tax that you're paying. And now's a great time. Your potential clients are getting their information ready to send to their TPA. So it's a great time to kind of plant that seed of, hey, there may be an opportunity to reduce last year's tax bill.
Yep. All right. Great foundation. So now we can have some fun, maybe get into a case design or sample census. Couple questions from the audience, Scott, and you'll probably cover that in the upcoming slides. But yeah, you have to have like benefits for all participants, and buy insurance for every employee. You can't treat the owners differently. So as you get into the plan, the sample plan design, if you don't mind, please speak to the owners versus the rank and file, and the impact of even a highly compensated employee would have on some of these plans.
Sure. Yeah. So a couple of things, and I have a couple different samples, like one that's owner only, one with employees, and one with a lot of employees. To start with, it's, hey, here's a S corporation, two business owners, right? They do online subscription-based education, right? Create content, and it's just a great business model. North of 2 million of profit annually, right? Came to us, wanted to see what was possible. All right, so we set up just a cash balance pension plan. We could add 401k, but it really wasn't necessary because we could get them 756,000, right? Deductible contribution. They save 317,000 right off the bat in income tax, right? So that's kind of the door opener. Why life insurance? Well, they can fund two benefits here, not just the retirement ceiling that they can roll over to an IRA, but they can also fully fund a policy that's not subject to that ceiling. And they realize that, hey, they're high income and high net worth, right? They love the tax deduction, but they know that they need to do some planning on the back end to kind of balance that out. Kind of similar, but what if there's employees, right? So here, it looks very similar for the business owners, right? Large contributions, 642,000 combined for the business owners, big tax savings, right? Well, what do the employees get? The employees get a fantastic retirement plan, right? Total of about 10% of their compensation funded by the company. I would argue that's a great retirement plan. But keep in mind, the owners are keeping almost 98% of every dollar that goes into the plan, right? So a lot better off than paying 37 cents on their last dollar of income to IRS. So we have a lot of clients that kind of fit this profile. Now, we could add 401k. A lot of times 401k would be added here. That's great. Can add contributions for the owners, doesn't really change the contribution cost for the employees. In this type of group, we're going to cover every employee, right? They're all together in the same office. The cost is not that high. Most of the time, we're just going to cover all employees. Everybody gets a contribution in the defined contribution profit sharing plan. Everybody has a benefit in the cash balance plan, and everybody has the same type of life insurance policy. I could not do this where I give just policies on owners in the pension plan and no policies on employees. I have to satisfy IRS benefit rights and features requirements. The employees are going to get same type of policy, albeit at a smaller benefit level because their overall retirement benefits are lower.
Well said. So the numbers seem a little lopsided here, Scott. So to walk us through how we can create so much value for the owners, yet mitigate contributions to the rank and file.
Yeah. The Internal Revenue Code has a sentence: retirement plans may not discriminate in favor of highly compensated employees, right? One sentence, probably somewhere in the neighborhood of 2,500 pages of regulations, notices, et cetera, that define that. So big picture, there are just a lot of mathematical tests that we go through to show that enough of the non-highly compensated employees are projected to receive sufficient benefits to have a measure of equivalence with the owners. Here I have two different plans, and the Treasury regulations tell me I can project profit sharing contributions forward at 8.5%. And I can use a lower interest rate if I define it as such inside the defined benefit or cash balance pension plan. So I always end up with some sort of arbitrage, right? That we can show very high contributions in a pension plan and overall for business owners, a more moderate dollar amount of contribution for employees, but show that that satisfies the IRS non-discrimination testing requirements.
Fair enough. How about a mid-sized firm? Like we're getting some questions from the audience, like where does this work? Is there a hard and fast rule? Is it 7-2, like you said earlier? Is it 9-1? Where do you start to identify the size of the firm and a good-looking census per se, Scott? Because that's what really drives the plan design, is the census and the accuracy of the census.
Yeah, I mean, I look at it at varying degrees, right? This one is a slam dunk. It should be, right? Or a layup. It's, hey, no employees, no cost, right? So I either write a bigger check to IRS or I don't. I have a few employees, but I'm keeping the lion's share, right? So I know that this employee census is going to look great if the owners want to maximize. Then so I call it a 15-to-1 ratio. I know is going to work, but there is this ability to go up market, and there's not really a hard and fast rule, but we can, if you get me an employee census, I can pretty quickly tell you if it's going to work. Is we can take this up market, and a lot of like automobile dealerships, distributing companies, sometimes some large high-end home services companies kind of fit this model. If they're closely held and high income, right? I can do something that's pretty powerful even if they have a lot of employees. And sometimes it comes down to a little bit of ratio, right? So closely held group, 4 family members that own the business. This is an automobile dealership with a couple locations. 17 other highly paid employees, 94 non-highly paid employees. So 11 million of payroll. I would say that this is walked by every single day as an opportunity. No one thinks of it. But a company like this has probably had a 401k plan for 20 or 25 years, right? You know, in most states, they'd be required to have something or participate in a state program. That kind of presents an opportunity. If I have a closely held group I want to benefit, I have a lot of other highly paid employees that I'm not really going to do anything for. I can deal with a lot of other non-highly compensated employees if the plan is not top heavy, right? So here, 401k plan, 11 million of payroll. We added a cash balance plan, about $1.2 million of funding for the business owners. They were in California, right? We know that that's going to save them 500,000 right off the bat in income tax. Contribution cost 49,000 for a subset of employees, right? So we get something where the business owners keep a lot of the contributions, saving taxes, and it's a pretty moderate contribution cost with the kind of more of a mid-sized firm. Here, you know, it's a little bit different. We're not going to cover all of the non-highly compensated employees. That would get too expensive. So when we kind of go up market, we really look at the employee census and figure out, okay, from a relationship standpoint, who can we cover, right? You know, dealerships that have different locations, well, that's easy, right? Sometimes it's let's cover the office staff, but not the field employees. So it gets a little bit more complicated, but it does open the door to, I think, a bigger opportunity than sometimes people think of for a cash balance plan.
Good stuff.
Yeah.
So I know everyone in the audience wants a number, Scott, and it's hard to give a number,
Okay.
particularly looking at this type of
Yeah.
structure where you have so many employees, but you're able to make it work. If you had to just really spitball,
Yeah.
what's the ratio that you're really starting to look, you know, at driving 80% or more of the contribution to the owners?
Yeah, I mean, I would call it a 15 to 1. If you give me 15 employees per business owner that wants to max out, I know it's going to work. You know, 20 to 1 usually is going to work, right? 40 to 1, I start to get a little iffy.
Yeah. And there's a lot of factors as you described, right? What state are they in? What's the marginal tax bracket? What's
Yeah.
the age difference between the owners and the rank and file? You know, what are the incentives behind adoption? Is it employee retention? There's some you know intangibles here that need to be considered in establishing that hard and fast number. But that
Well,
was a good example. What about, and your next slide is going to walk right into, what about the young owner with a side hustle that's gonna has their primary income? Actually, specifically in the chat, there's a question about a traveling nurse who has a W-2 income and then some 1099 income. That kind of plays right into this particular slide. Can you just spend a minute here?
oh yeah, yeah. I mean, traveling nurses are great. A lot of ER docs sometimes fit that profile. This one was, you know, it's a professional athlete, NFL player, off the field income, right? So I try to roll those two things together, right? Side income, what can we do? Somebody that's young. So 500,000 off the field, side income. We set up two plans, a 401k profit sharing plan, but they're not going to use the 401k component, and a cash balance pension plan. And I like this because this kind of goes back to that modern concept, right? Well, what are we doing? You know, they pay a lot in taxes. Let's get them a deduction, right?
Mm-hmm.
Profit sharing plan deduct contributions deductible. The pension plan funding is deductible, 121,000. But since they are the only individual, I can layer in this after-tax contribution that they can convert under current law immediately into a Roth account inside the profit sharing plan, and the life insurance policy that they're going to fund for a period of years and ultimately move out of the plan, right? If they want to, I could rely on those two vehicles in the future for some tax-free income, right?
Yeah.
Plus my other assets are going to grow tax deferred. So
Yeah, well done here. Take it a step further. You can leave the athlete out of the business service corp, employ mom, dad, brother, sister with a W-2 wage, create some discipline in the eliminate the randomness of gifts, right?
Yeah.
Have mom, dad, brother, sister promote the brand, manage camps, book travel, like do legitimate, day-to-day, occupational type duties. And once you have a W-2 wage for mom, dad, brother, sister, and they're earning their own Social Security, you can then layer in an additional pension expense so that once the athlete is finished their in-service time in the league, mom, dad, brother, sister have some financial independence through
Mhm.
the form of Social Security and the pension benefit, and player doesn't have to carry them post career.
Right.
By adding the life insurance, you build in a cost recovery mechanism that, where after mom, dad live a long, healthy life, their
Yeah.
prized son or daughter or athlete is the named beneficiary, whereby they can cost recover all the financial support they've provided over the years. Not the everyday marketplace that you're going to see, but it's certainly some creative planning there.
Sure.
When you think about young athletes and entertainers who want to provide for their families, great tool.
Yeah, absolutely.
So question, and again, Scott, it's like the audience almost knows what's coming in your slide deck.
Okay.
When can you adopt these plans, and what have some recent changes to the tax law afforded us by way of recent opportunity in even planning for 2024 today as we sit on February 20th, 2025?
Yeah. The Secure Act, the original one, allow qualified plans to be adopted up until the due date of the business tax return, including extension. All right. So no matter how a business is taxed, if they extend their return, I know we have up until at least September 15th that we could set up a plan. They could fund it and get a deduction for 2024. So as much as we would love business owners to be really proactive, right, about their tax planning, I feel like this is a great tool, right? For any of you golfers, we all love a mulligan every now and again, a
Yeah,
do-over,
yeah, yeah,
and
yeah,
this provides us the opportunity to do that.
yeah,
So,
yeah.
it's a
This,
great time of the year to kind of just throw that out there. Hey, are you not happy with the check you're going to have to write or how much you paid in quarterlies for 2024? There's a way that we can make that better.
yeah. So Scott, are you telling me that this one is an amazing result of a bipartisan sponsored bill that could actually help the American people?
Yeah, believe it or not, right?
Unbelievable.
Yeah,
Unbelievable.
I mean,
Quick.
I think there's a lot people don't like about the Secure Act and when
Yeah.
Congress does something, but
Yeah.
for
Yeah.
financial advisors, for closely held business owners, it's been wonderful.
Yeah, amazing work. And a quick shameless plug to our friends at Fonseca. They were extremely instrumental in supporting the Secure Act 1.0 and 2.0. So if you're not active with Fonseca, this is a result of some of their work and some bipartisan planning. Um, okay, so there's no mistake, Scott, that you and I are here speaking about these opportunities in February of 2025, where virtually every customer of folks on this call are analyzing their income tax liability from 2024 and can still implement tax mitigation tools today.
Yeah, absolutely. Plenty.
Potentially,
Yeah,
potentially as far out as September 15th,
yeah.
2025.
So plenty of time for them to kind of think about it, understand it, right? Let's show some different funding levels, right? Get back with the CPA. So it's nice. We have plenty of time. The key is just if you think it may be a good fit, probably extend your tax return. I mean, I think most small, closely held business owners probably do anyways, but extend your tax return buys us up until at least September 15th.
Yeah. All right. So as we move into the next phase of the presentation, we talked about going in on the front end, adoption, who's the right candidate, potential tax deduction. Let's talk about what we can get out of these plans by way of assets.
Mhm.
Assuming we do engage with life insurance and add that to the plan, how do we get the life insurance out of the qualified plan? And what are the rollout strategies and the mechanics and the economics behind the result of implementing one of these plans?
Yeah, Anthony, I always think that if I think of qualified plans in general, right? I love the tax deduction, love the tax deferred growth. For my clients, high income, closely held business owners, maybe high net worth, right? I the taxes on the back end can be a problem. Required
Yep.
minimum distributions during life, within 10 years of death, inside the taxable estate. You know, we all know life insurance gives people flexibility how they use it, ability to have tax-free buildup, take it for income, keep it for wealth transfer purposes. The challenge is, a lot of times it's more expensive upfront, right? There's the carriers recouping, some of the upfront cost early on. So that's where I think this really becomes pretty powerful, is how we can be pretty strategic about it, very efficiently put these two things together to come up with the best outcome for closely held business owners. And we always kind of look at it strategically, right? It makes sense to include it in the plan because it's an additional benefit, right? It's a retirement benefit plus a death benefit. They can fund more. But really, when it really becomes powerful is we think over their lifetime what the life insurance can do for them, and to be strategic of acquire it inside the qualified plan, but at some point in time move it out of the plan into personal ownership or grantor trust, right? So life insurance can never be owned by an IRA. So assuming someone survives, it's always something we've had to address and deal with at some point in time. And we just like to be strategic about it up front. So there's really two different ways that we can get a policy out of a plan. It can be distributed from the plan if the person's eligible for a distribution. Very, very few of our clients do that because it becomes taxable income to them at the policy's fair market value. Instead, most of our clients will rely on a Department of Labor prohibited transaction exemption and IRS rules or Treasury revenue procedure, which tells us how we determine fair market value of the policy, and allow the individual, a relative, or an ILET to buy the policy from the plan. I use the term swap, right? Because in essence, what's going to happen is the individual is going to swap some cash into the plan so that the policy can be sold, move out of the plan to personal ownership or their grantor trust. And so what we end up with is kind of a lot of times something that looks like this, right?
Yeah, can I interrupt you 1 second?
Sure.
If you go back one slide,
Yeah.
I'm sorry, maybe two slides. Keep going. Backwards.
Other way.
Yeah. Well, forward.
Yeah,
Perfect.
Yeah.
Okay. So I don't know. I was born in 1976. The rumor is that my generation wants to know. We want to know what the destination is first, and then figure out why it makes sense and how to get there, right? And we're always skeptical. So this kind of sticks with me. And this, if you understand the rules of pension plans, this is the destination, right? This is where we are going. So if you are establishing a plan and your destination is age 62, then Scott and team can create a plan that gets you to a lump sum number of $3.52 million. If you're not going to wait until 62 and you want to wait till 52, well, that number is 2.1 million. And if you're really impatient and you need to shut it down at age 42, or you have a career change or something happens from an economic standpoint, then your lump sum is 1.3 million. So everything that happens from now until the destination is targeting this number. And if you are familiar with these numbers, then the next piece of Scott's presentation is going to make perfect sense. And he's going to start to talk to you about the different vehicles that we use to get to this destination. Fair?
Absolutely. So taking that in mind, and this We'll show a design and here's what you can contribute today. People love that. But they also like, okay, well, what do I get out of it? And pension plans can be flexible, right? They don't have to make the same contribution every single year. But let's say you had a client that starts a plan at age 53 and they want to fund, the maximum amount they can. They're going to hit that 3.5 million as soon as they can. What we'll show them is something that looks like this. On the left, what does the funding look like? All right, so early years, we're funding both life insurance and investments or an annuity. 390,000 going into the plan, right? Split between funding a traditional investment account or an annuity and paying premiums on a cash value life insurance policy. At year 5, this client had overfunded the policy, wanted to move it out of the plan. So that particular policy's fair market value was 457,000 at that point in time. So they're going to swap 450,000 into the plan, from someplace else goes into their plan investment account. So I think this is important. This is not a cost, right? This is just replacing the life insurance, pulling the life insurance out, putting something of equal fair market value cash into the pension plan, right? So the life insurance policy goes out. This was a policy that with just those 5 premiums had a projected death benefit at mortality age of 6.2 million, right? So I know that they now have something outside the plan that's illustrated to be paid up that is going to be income tax free. If they want to use it, they can pull from cash value, use it for retirement income, balance out the portfolio, has an income tax free death benefit. They could even move the policy into their grantor trust, have the grantor trust buy it, where it's outside of the taxable estate. Thereafter, they're going to continue to fund the pension plan another 5 years until they accumulate 3.5 million inside the investment account. They're going to terminate the plan and roll that over to an IRA. Right? So what have we accomplished? Well, we've saved them well north of $1 million over the 10 years, right? So probably their peak earning years, saving $1 million in taxes. I'll take that any day. But they also have funded 2 assets that are tax preferred, right? The sizable IRA that can continue to grow tax deferred, can be great for providing retirement income, but we all know is going to be subject to some taxes on the back end, right? And a paid up life insurance policy that's going to be completely income tax free. So I look at this and there are more plans that don't have life insurance than do. And there's probably about 40,000 existing pension plans that don't have life insurance, where they just accomplish this large IRA, and that's great. What we like to show is that by incorporating life insurance, right, they've almost probably doubled the value of this pension plan because they now have this paid up asset that they can use for tax-free benefits in the future.
All right. Now we're getting into the heart of the matter here, Scott. So there's a couple of things. I see you did a 5-pay life insurance policy.
Mm-hmm.
Why do you like to do a 5-pay life insurance policy? And give us a flavor of which policy type you like and why a 5-pay makes so much sense versus the type of plan designs we typically get from the carriers that are paying for the next 50 or 60 years.
Yeah, part of it just goes back to, the mindset of a closely held business owner. Part of it is how can we optimize this entire solution, right? Type of insurance, universal life, whole life. I like them both. I would have a conversation with you and the advisor of what's the appropriate fit for their client. What's their comfort level. I don't want to take somebody out of their game of what they're comfortable with, right? So I look at the qualified plan as just being a more efficient way to fund a policy. I like, I like overfunding the policies and kind of being done with it because I know that this is complicated stuff. We try to break it down to make it as simple as possible, but it's easier for me to show, fund a policy here pre-tax for a period of years, right? Move it out of the policy and don't fund it thereafter. You can if you want to, right? In a lot of cases, but I like to be able to just kind of show, hey, all the funding is here inside the pension plan. Here's what you get out of it, right? And without going into, hey, you're going to have to keep funding this policy forever. It makes my conversation easier. I think it just kind of works more with life insurance today, modern life insurance policies anyways. So part of it is simplistically, right? That I think it's easier for everyone to understand if I overfund a policy in short pay, and it kind of works better, right? Because in that point in time, with most of the products we use, I'm comfortable where fair market value is going to be. You know, if I show a fund a policy 25 years and it's still in the qualified plan, I don't know where that fair market value is going to be, probably. And I think everyone's going to forget. This is something where I can capture them, I can remind them of it, right? It's just a time frame that I'm more comfortable with.
So more predictable upon valuation, better performance. You're not creating this mindset of an additional expense post-retirement that you're going to burden the participant with.
Yeah.
And it's so well funded that you can actually utilize it as either a volatility buffer in their name or a legacy wealth transfer vehicle inside of a trust.
Right.
Makes sense?
And yeah, and sometimes we'll show, I mean, depending on the policy, right? We might show both. We might, to really highlight the flexibility of, if your client's very familiar with cash value life insurance and very sophisticated, they may not need it, right? But a lot of people, it's like, hey, this is something that you can use for income, right? This is something that, you can not touch during your lifetime, and it does wonderful wealth transfer.
Scott, talk about distributions versus a swap. Well, let me take one step back because I have a technical question from the audience. Could you swap appreciated stock into the plan instead of cash and avoid the gains on the appreciated stock, or does it need to be cash?
No, I mean, you're going to pick up the capital gain anyways. It's just cleaner, easier if it's cash.
Okay.
Even if you could put stock in there, right, you're not going to avoid the capital gain.
Okay.
So when we have this conversation up front, right?
Yeah.
That's a talking point of, hey, where's this money going to come from? And I don't want them to think that that they're not going to have to swap in cash to move the policy out. So sometimes it's, well, I have this high basis stock, right? That's not going to create a capital gain, so I'll liquidate that at that point in time.
Right.
Other times it's, hey, remember, we're saving you 100,000 or 200,000 a year of income taxes, right? Let's take some of that money and put it aside so that we know it's liquid at the right time.
Scott, we talked about, and this slide maybe through a swap caters more towards a high net worth or an owner. Let's talk about someone who may not have the means to create a swap or possibly even rank and file. How do the non-highly comp or someone who doesn't have a well-funded trust with the ability to swap, how do they get the policy out?
Yeah, I mean, sometimes with rank and file employees, it's leaving that death benefit and that policy in the plan for a longer period of time if you're not going to terminate the plan. Sometimes they just take it as a taxable distribution, right? So part of their, benefit is going to be a rollover to an IRA. Some of it's going to be this policy distributed out to them, and they pick it up. They pick up the fair market value as taxable income. There are occasions where they'll just elect to surrender the policy, right, inside the plan and roll over everything to an IRA. I don't, that most of our clients don't do that, right? We want these to be long-term policies, but that is an option too.
Scott, what type of rate of return do you typically model from an actuarial standpoint to reach that destination of 3.5 million is a question from the audience.
Yeah, I mean, for when we do our modeling for kind of putting together designs, I think we normally assume 4 or 5% on the investment assets. We, assume illustrative rate of what, on the policy. I think that that's a misconception sometimes,
Yeah.
of, hey, 3.5 million is my in-game ceiling, right? I don't want to go above that. I wouldn't, if I had an aggressive client, and I've seen this, right? Hey, they're super aggressive in their investments. They love the pension plan until someone says, well, your investments should be conservative. And they hear that and they're done. There's no going back from that. So, if 3.5 is my destination, right? Yes, I can't go wrong. I can't get in trouble by having conservative investments, right? But I have a lot of clients that want to capture some market return, right? So they'll, in their investment component, they'll be slightly aggressive early on. And if they do well, that's okay. We'll just dial down the funding later, right? Until we get really close to that ceiling, it's okay. They don't have to be conservative if they don't want to be. So I think that is a misconception that I see, from investment advisors, is that defined benefit plan has to be conservative. That's okay.
Yep.
You can be conservative, but
Yep.
if it's going to turn your client off to a great tax strategy, there's
Yep.
ways around that. There's ways that can be managed, to avoid any issues.
All right, believe it or not, Scott, we only have 3 minutes left.
Oh no.
We have answered 23 questions from the
Nice.
audience. So,
Good.
so great job here. Let's spend the last few minutes on the second strategy that is probably a smaller demographic called the retirement tax minimization strategy, whereby someone has reached the destination, right? Call
Mhm.
it 3.5, sometimes more, right? I've seen qualified plan balances north of $300 million for CEOs of ESOP companies. Um, you have a bunch of seasoned money in the plan. You're subject to estate taxation, income taxation to the beneficiaries. Secure Act forces all the money out after 10 years. What's a strategy that you would employ in using qualified assets to benefit next generation or wealth transfer?
Yeah, it's high net worth individuals with estate tax exemptions, where they are now, if they're above that, right, that the IRA, the qualified plan, is probably one of the worst assets for wealth transfer purposes, based on it's subject to income tax and estate tax for those individuals. So there is a strategy. If you have a business owner, right, that can make a decision for a qualified plan, and you have an IRA or qualified plan money that you can move into a defined contribution plan via rollover, that, this strategy becomes available. And again, it's really the same thing as far as strategically acquiring life insurance and moving it out, in this case, to a grantor trust. It's just using accumulated dollars instead of new money going in. This is different because in this instance, you can buy life insurance, you can buy a survivorship policy, right? In a pension plan, it pretty much has to be a single life policy on the individual. So what we'll show is roll money over to a qualified plan, use that to fund a life insurance policy, right? Right off the bat, since it's life insurance, we've leveraged it up. What could transfer, generationally if they pass away. We've reduced required minimum distributions because you're going to have a life insurance policy that has some expenses up front. Ultimately, we're going to move money, have them move cash into a grantor trust via gifts or loans, have the grantor trust buy the policy directly from the qualified plan, right? So that we get this asset, that if we don't do anything is going to get hit with income and estate tax. And we've converted a portion of it into, we've leveraged it up and converted a portion into something that's going to be outside of both income and estate taxes.
Got high level, maybe 30-second overview, quick case study for us.
Yeah. So business owner in the Northeast, high net worth, had $2 million in a qualified plan that they knew that they were never going to touch, right, for retirement income. We showed them if they don't do any planning, right, this asset, assuming it grows at 6%, they take RMDs, pay income tax, invest the difference in a brokerage account. They pay a lot of tax on interest, dividends, and capital gains along the way. At the very end, everything that's left in the IRA and the brokerage account's going to get hit with estate tax. So we'll show them at 6%, these two assets, $2 million in a qualified plan, 1.3 in a brokerage account, could net 8.5 million to their beneficiaries. What we'll show them as an alternative, take the 2 million, fund a survivorship policy inside the qualified plan, later move the 1.3 million into the qualified plan so that the life insurance policy comes out. We can easily show them almost 15 million transferring generationally, 75% increase after they've survived 35 years in the future, right? If they die early, much higher increase in what goes to beneficiaries, which works, for a lot of clients that are focused on legacy planning. A lot of our clients just hate paying taxes, right? So along the way, we can show them that by doing this, they paid on these assets 6.1 million less in investment income and estate taxes.
Well done, my friend.
Yeah, thank you.
That was quite a mouthful.
Yeah.
So as we approach the top of the hour, first I want to thank my associate Scott McHenry. What really job well done, Scott. Thank you. Really well done.
Appreciate it. Thanks, Anthony.
As a follow-up item, you will get a recording of today's webinar. You will also see follow-up blog articles on our webpage that will be sent to you automatically. We will provide you with a census/fact finder so that if you have a prospective customer, we can start to vet that and design that for you. Scott has also agreed to look at existing plan documents to see if we can improve any existing plans that already may be in place. And also in my follow-up, I'm going to describe how you can work with Life Brokerage and Scott's firm. There is a split on revenue. He works in two different manners. One as a designer/back office. And then secondly, we'll also help with joint presentations and help with point of sale. As you can tell, his style and demeanor is very similar to ours. He is educational. He is not salesy. And I can tell you that whatever percentage points you're giving up, you're in good hands, and it will create so much additional value than trying to do it on your own that I would highly recommend partnering with McHenry. So, Scott, we killed it. You killed it. We also answered 24 questions. Whether you knew it or not, I was weaving them in and out of your presentation. You handled it. You handled it like a champ. I want to thank everyone for their participation, and please be on the lookout for our follow-ups.
Great. Thanks, Anthony. I appreciate it.
Be well. Thank you, Scott.
Bye.
Bye-bye.